I am really excited that you were able to join us today. This is going to be a really, I think, interesting webinar because online we had almost 500 people sign up. And because we're doing this as a meeting as opposed to a webinar, we're actually capped at 100. So it'll be interesting to see if everyone who signed up tries to get on. We're definitely going to have some bottlenecking if that's the case. Before we get started, I just want to talk through a couple of things. Make sure that you follow us on social media if you're not doing so already. And I'll probably do this again at the end just in case anybody misses it. But you can follow me at The Wealth Woman on either Facebook or Instagram. And if you're not following me on LinkedIn, you can find me as Mary Kane Lyons. And I think you can find us if you search The Wealth Woman as well. And then please make sure that you are also following our company page. It is at Benchmark Income. We would love to be able to communicate with you and make sure that you're getting all the information for the upcoming webinars and things that we're doing. And if you are not currently signed up for our newsletter, we'd love to have you do that as well. You can do that on the Benchmark Income website, which is benchmarkincome.com. You can also, for more content, even above and beyond what we're going to talk about today, take a listen to our podcast. Eric Alexander, the Benchmark Income Group investment guru. He is our go-to for all things investment internally. He and I have a podcast called The Big Wealth Podcast, and you can find us anywhere that you listen to podcasts. So if you get the chance, definitely give that a listen. And before I get started, I just want to take a minute to thank our amazing team. We launched Benchmark Income Group just over a year ago with 4 of us. And in the short time period of a year, we have grown from 4 people to 15. And I am very excited about that growth. And we have put our advisors through a very grueling incubator because we at Benchmark Income Group, we believe that one of the problems with our industry is that people have 1 year of experience 20 times over pretty frequently. So maybe they've been in business for 20 years, but they haven't learned a whole lot in that time period. And so we focus very, very much on education. And we've put together an incubator, which requires our advisors to go to class every day. And frequently they have substantial homework, quizzes, pop quizzes, that sort of thing, to make sure that they're really giving the best to our clients. And so I'm delighted to have the people that we have on our team because they tend to be very, very purpose-driven, and they're all about people before profit. And I think in this day and age, that's frequently hard to find. That being said, I will introduce myself. So you probably had an invite you. And hopefully they told you a little bit about what to expect, but I'll kind of lay the groundwork for that anyways. I am Mary Lyons, the Wealth Woman. I have been a financial advisor for, oh goodness, I don't even like to say this out loud anymore, over 15 years. I remember when I was just starting, I really wanted to be able to say I had more years of experience. And now when I say that, I just feel old. But I do think that one of the things that makes our firm unique is that we tend to take an outside of the box approach to money because we don't think that the traditional ways of growing wealth are actually really growing wealth for American citizens. So this webinar is going to give you some new insights into things that you can be doing so that you can grow your wealth much more quickly and a lot of times do it much more safely just by taking a more efficient approach. I got into this business. I'll give you a little of my history. So I started as a mortgage broker when I graduated from college. I had the opportunity to start a mortgage company as a 21-year-old for a financial services company. And at 21, I think I was full of hubris and was like, oh yeah, that'll be easy, and accepted the job with no salary to start this company. And within 6 months, we were up and running. And within a year, we were profitable. And I enjoyed having the conversations with the advisors about what they were doing for their clients. The firm I worked for did a type of planning called economics-based planning. But I was focused on the mortgage piece and really integrating the mortgage into an overall financial plan. What I ended up doing after 3 years is I decided that while the mortgage is a very important piece of the financial plan, because it is the largest purchase that most people make during their lifetime, my passion was really about the greater, broader conversations of money. And because I had niched myself really on the side of financial planning, even within the company that I was working for, I had most of my referrals coming from other financial advisors outside of that company as well. And what was interesting is that the referrals that came from the advisors outside of that company frequently were from well-respected companies. But because I'm a nosy human being and I was asking people, well, why are you doing that? When I got all of their financial information, by the time I was 3 years into the industry, almost 70% of my clients were asking me if I would take over as their financial advisor. And so at that point in time, I decided, hey, maybe there is a real need for the kind of conversations that I'm having if they're not getting it from their existing financial advisor. And I made the transition over into the financial services industry. And I have been doing this ever since. I worked for a company called Personal Economics Group for, I think, 12 years. And moved from just an employee into a management role and eventually into ownership. Sold that company, stayed on with the new owner to help him get transitioned over a 2-year time period. And then a year ago, we launched Benchmark Income Group. So that's kind of our history. But we take a very, I think, different approach to money because we question the status quo. And we want to make sure that the work we're doing really is the most important work that can be done. So that being said, we will just jump right into this. And, I'll just say this for any of my advisors who are also on this call. If at some point in time you want to jump in because I've missed something or there's something that was relevant in your journey, please feel free to step up and say so. Because as we all know, I rarely do the same presentation each time. So this is just our disclosure page. We're just going to let that be up there for just a second. But what we're really going to start with is some context, because I think context really helps. If you know what's happening, you will know what to do. If you don't know what the facts are, it's pretty good. It's pretty hard to make good decisions. So let's start here. Most of the time when I talk to people, regardless of income, it is rare that I hear people tell me that they feel rich, even when they are. So what I want to start with is understanding the context of where you fit in American society. So financially, right? Socially, that's up to you. Financially, we know the numbers. So what I want you to think about right now is this question. What do you think your household income would have to be right at the 50% threshold? So half of the households in the United States make less than that. Half of the household in the United States make more than that. Where do you think that line is? Keep in mind, this can be a single family income or a single person income for the family. Maybe one spouse works and one stays at home. Or this can be a dual income family as well. So 2 people working. And what I want you to do is just write down that number because we're going to do a reveal here in just a minute. So 50% of the population makes more than this number. 50% of the population makes less than this number. Okay, now that you've written that down, what do you think it takes to be in the top 25% of all households from an earning perspective on an annual basis? So this is the annual income. We're not talking net worth here. This is the annual income that your household would have to earn to be in the top 25% of all households in the United States. That means that 75% of the households make less than this number. Go ahead and write that down. Now let's do the top 10%. What do you think your household would have to earn to be in the top 10% of all households in the entirety of the United States? Now do top 5. Top 5%. You're earning more as an annual income than 95% of the households in the US. And you guys are all on your computer, so you could be Googling this. Don't cheat. What we're looking for is just your gut reaction. Don't overthink it. Now, what do you think it takes to be in that magical 1% that gets talked about on the news all the time? What income would you have to earn each year to be in that 1% range? Go ahead and write that down. And now I'm going to do the reveal for you guys. Are you ready? To be in the top 50% of all earners, your household only has to earn about $40,000. This means that half of the households in the United States, regardless if it's a single person, 2 people living together, or a family of 8, are making less than $40,000 a year. To be in the top 25%, your household has to earn about $80,000. To be in the top 10%, your household needs to earn 138 or more. To be in the top 5%, your household has to earn about 195. And then to be in the top 1%, you can see here we have a big jump. Your household has to earn about $480,000 per year. And I will also tell you, if you look at the same data, but for DFW, the number is over 500,000. And if you look at it for Dallas proper, for Dallas County, the number is above 550. So even within our little metroplex, we kind of skew above average here. And one of the things that I think is really interesting is that a lot of the people that we work with as a firm fall into that top 25 or top 10% category. And yet when we ask them, do you feel wealthy? The answer is frequently no. I feel comfortable. We hear that a lot, or I feel like I'm well off, but am I rich? That's not how I would necessarily describe myself. That's the answer we get when we ask that question. And a lot of people seem to think that that top 1% actually starts at a much higher income. And when you look at dual household incomes, especially when you have 2 professionals working, being in that top 5 or that top 10%, doesn't necessarily feel wealthy, right? But the context is key here. Because if you wrote down, looking at your numbers, that you thought your household income was at the halfway mark or even below the 25% mark, you're going to approach building wealth in a very different way than you would if you were approaching it knowing that you're in that top 5% or 3% or 2% or even that 1% number. And that context, I think, is important because it can become a limiting belief if you don't know what possibilities are actually there for you. So if you know you're in the top 10% of all households, you're going to approach your wealth building very, very differently than if you believe, oh, I'm just kind of average or normal. But when you look at this, if you fall anywhere above that 25% mark, pat yourself on the back. And when I tell you, especially if you are at the younger end of the earnings scale, if you find yourself anywhere on the top 50%, knowing that you have upward mobility during the rest of your lifetime, you're doing great. Just keep on pace. Okay, so now we're going to talk taxes for just a minute, and I'm going to stay away from all the political stuff because I think there's danger there, regardless of which side of the table you end up on. But I do want to make sure that you have context because the information and the facts are really important when we're making decisions. So if you look at the top 1% of all earners, you can see that that represents about 39% of all the taxes collected in the United States. So a lot of times we hear that people who are really wealthy aren't paying taxes. What I would argue is that's probably not the 1%, it's probably the 0.01%, because most of the business owners that I work with who are making $300,000, $400,000, $500,000, or even $1 million are paying a pretty hefty sum in taxes because they're earning their money for the first time. And what you can see as you kind of click through and see this is that the top 5% is responsible for paying about 60% of the taxes collected in the United States. Now, you might notice as you're looking at this that if we add the 40 and the 60, we're already at 100%, but these are not numbers that you're going to add together. This 60% actually includes that top 1%, right? So it kind of rolls into that. So if we look at the top 10, that's 70% of the taxes collected in the United States, and so on, right? So not quite, but almost 100% of the taxes collected in the United States are paid by the top half of the population. The United States actually has one of the most progressive taxation systems in the world. But when you look at who actually gets hit the hardest in terms of paying taxes, it's the upper middle class. So when I think about who we work with, it is people that are really trying to build something for themselves and for their families. And you're really at the forefront of bearing the tax burden in this country. And so part of the strategies that we want to pursue are ways to give yourself some relief in that arena and also build wealth at the same time. And if anybody has any questions, you can go ahead and put it in the chat. And what I'll tell you is the data, so somebody mentioned that surely this income data has changed quite a bit since 2015. It does, but the way the IRS reports everything is in arrears. And even with that, you're not seeing substantial movements, because if we go back even to 2010 and the data from that, you're still looking at here somewhere in the like 380, 390 to 450 range. So we have seen it trend upwards just a little bit, but it is not as dramatic as you would expect it to be. So what I want to talk about now is preconceived notions, because I think that how we approach information determines what we absorb. So I want to talk about how we actually learn and the information that's out there. So if I think about kind of the world of knowledge or the knowledge pie, there is a whole world out there that we can learn about and that we can know about. Of that, there is a sliver of this, and we've probably exaggerated it in terms of size, but these are the things that you know to be true. So these are the things that you've learned about. These are the things that you're focused on and that you've done the research on and that you know. In addition to that, what you can also find are the things that you don't know. So an example of that would be, for me, astrophysics. I know it's out there. I know there are people who are experts in astrophysics, but I also know that's not me. I don't really know much about that. Then in addition to that, right, how do we expand that? If I look at what we know, right, I know I've got some blind spots. There are things that are out there that I don't even know they exist. I think about, kind of old school, the way people think about money. It's real easy to see, like, they just maybe don't think about it. There's a blind spot there. So the way we learn is three different ways. One, the experiences that we have. So if I go out and take out a loan and I get upside down and I have a really bad experience, I may believe that all debt is bad, right? The experience is what actually teaches me that. Personal study, the things I read, the things that I really do the deep dive in, that I research, that I do the experiment on, are going to expand what I know. And then transferable knowledge is what I learn from other people. So I'm learning from their experiences and their study as opposed to my own. My hope today is that I'm able to transfer some knowledge to you all from things that I've learned over the past 15 years. What I think is actually the most dangerous about all of this, though, are the things that you think you know that aren't so, right? The things that you believe to be true that might not be. I'm going to label these preconceived notions. All of us have things that we currently believe that may or may not be true. That's what gets us into trouble, because once we decide that we know something, that we've arrived, that we are experts on that thing, we stop listening and we stop learning. And it is those things that get us into the most trouble if we have an assumption that is wrong that we need to correct. And I think what's really key here is, if there was something that you believed about money and it happened to be wrong, do you want to find out now, or do you want to find out 30 years from now when it might be too late to do something about it? So we're going to spend some time on those things, and we are going to start by playing a game. So you guys can kind of write the answers down as we go here. Kara, if there's polls about that, if you'll just kind of unmute yourself and like say the question out loud, and then let me know when you want to go through the results. But here's the game we're going to play. Let's say that you're going to go buy a new car. And in this example, and maybe it's new, maybe it's used, that's irrelevant for the game that we're playing today. But we're going to say that the price of the car is $30,000, and you have $30,000 sitting in cash at your bank. So you walk into the bank, you've got your briefcase in hand, you're ready to put the cash in there, and you walk up to the teller and you say, "Hi, excuse me, I'd like to withdraw $30,000 of cash in $1 bills. Please stick it into my briefcase." So the teller takes a look at you and says, do you mind telling me what this is for? And you say, "Yeah, absolutely." Oops, sorry. You say, absolutely, I have no problem telling you what this is for. I'm getting ready to go buy a car and I just need 30 grand in order to do that. So the teller says, just a minute, I have to go get my boss. So the big banker comes out and says, I understand that you would like to withdraw $30,000 from the bank. I have an alternate scenario for you. Here's the thing. If you leave your $30,000 at the bank with us, we get to loan it out and make a profit and loan it out again and make a profit and loan it out again. And depending on the type of account, we could do that 10 times or 20 times with your money. So we really would like you to leave your money on deposit with us. But we also know that you're not real happy because interest rates are so low and you're not making any money leaving your money here. So what we're going to do is we're going to move your $30,000 to a special account where you're going to get a 4% growth rate year over year for as long as you leave that money in the account with us. And that's going to be your growth rate, net of taxes and net of fees internally in the account. So how do you feel about that? It's pretty good. I know you can't get that deal anywhere else because interest rates are so low. So, you know, we're going to do that for you. But we also know that you need to purchase a car. So we're going to go back into the vault and we're going to get the bank's money and we are going to loan it to you, but we're going to charge you 6% on our money. So we're going to give you 4% on your $30,000 and you're going to pay us 6% on our $30,000. And I promise you're going to come out ahead. Do you believe the banker? Yes or no, right? Most of the time when I ask this question, the answer is no, I don't believe the banker. And when I ask people why, I get two answers. One, I don't trust bankers, which I think is an interesting response when someone says that. The second one is, no, I don't believe the banker because 6 is bigger than 4. I was in kindergarten the day that we learned this. And here's the thing about that. You're not wrong. 6 is bigger than 4, but the focus is the part that's wrong here, right? So here's the actual math. If I have $30,000 and I leave it in the bank earning 4%, and I'm going to look at a 5-year time period just because that's kind of a typical car note these days. I'm not contributing anything to this account. It's just $30,000 that's sitting there. I'm going to earn interest every year. And as I earn interest, the balance of my account goes up. So the next year I'm earning interest on a larger balance and a larger balance and a larger balance. This is your money on the compound growth curve. If you look at that 5-year time period, you're going to earn $6,630 in interest, right? So that's what's happening with the money that you left in the account. What about the money that you borrowed? $30,000 amortized over 5 years at a 6% interest rate means that your monthly car payment is $580, right? And what you can see is the amount of interest that you're paying each year is shrinking. The reason that it's shrinking is because they can only charge you interest on what you still owe. So even though your payment is the same month after month, the amount of money that you owe the bank is shrinking. And so the amount of interest that they're charging is shrinking with it. And more of your payment begins to be principal. Works the same way as a mortgage. So if you look at the amount of interest that you pay to the banker over that same 5-year time period, you're paying them $4,799. So if we look at that side by side, what you can see is you earned the $6,600, you paid out the $4,800. The difference is money that you continue to keep in your pocket, right? The net to you in this scenario is the difference between those two numbers. So here you are, you're ahead by almost $2,000, right? So the banker was telling you the truth. But here's the thing. What we do instinctively is focus on rate. And I find this to be true in all aspects of our finances. The problem is that when you focus on rate, you lose the perspective of what's happening with the flow of money. And the flow of money is much more important than the rate itself. So if you looked at this and said, well, I would never take a loan from the bank at 6% because it would be much cheaper for me to go down the street to the credit union. I'll move my 30 grand into that account where it's earning 4%, but I've got good credit. So I'm going to get a loan at a cheaper rate. If your interest rate was 2%, your car payment drops from $580 a month to $526. The amount of interest you now pay in this scenario is only $1,500. Now, the difference between what you're paying and what you're earning is $5,000. right? That is a huge difference. And you've essentially arbitraged the interest rates to keep money in your pocket. So sometimes I have people push back at this point and say, yeah, but if I paid cash, then I wouldn't have to pay any interest at all. Yes, that's true. But what happens when you pay cash is that money isn't sitting in the account earning 4% anymore, right? So there's no growth on it. And if you put the money back into the account so that you'll have 30 grand again, the next time you need to buy the car, you end up with 30 grand in a checking account, right? And even if you pay yourself back with interest, you say, well, I'm going to charge myself 2% in interest, which again, let's be honest, no one would. No one actually does that. Then you end up with $31,550 as opposed to $36,000, right? And if I can keep my cash flow exactly the same, why would I choose to pay the same amount and end up with less money in my pocket, right? That is the point of what we're talking about here. Getting your money earning for you, right? Without giving up the use of it. So let's go a little bit deeper here. Why do you actually want to be a wealth creator? Let's look for a minute at how the compound growth curve looks. So we're going to do an example here, and we're going to say that you're saving $6,000 a year. So again, this is just the 6,000 times the 5 years. So you've got 30 grand if you were going to make a purchase. If you look at the navy blue lines here, what you can see is over the rest of a lifetime, you're putting away $6,000 each year and earning 5%. So at the very beginning, you can see that the growth curve is relatively flat. But over time, you can see the growth curve gets steeper and steeper and more exciting because you're starting to see faster hockey sticking, right? So when I look at this, if I'm doing that for 50 years, I end up with $1.3 million. But if every 5 years I drain the tank, so I save up the money and I get my money off the compound growth curve, and then I go make a purchase, then I save it up again, and then I go make a purchase, right? So I'm saving it up and paying cash, saving it up and paying cash. You can see that you're cutting off all of that growth and the money is no longer working for you. And over a lifetime, that costs you almost 1.3 or just over $1.3 million because you keep interrupting the growth curve. Now, here's the thing. You don't lose these first few years of growth. You can see that you've repeated those first few years over and over again. What you're losing is the back end growth where you see all of that happening. So the sooner you can get your money onto the compound growth curve, the better off you are over time. And if we have the ability to maintain use of the dollars to continue making purchases, we may not be able to recapture 100% of the growth that we see here, but if we can retain some of the growth on that, we're automatically better off. And if I think about why this is particularly relevant, for most of us, between taxes, debt, and lifestyle, we are spending substantially more than we're able to save. And it is very easy to get focused on that little bit of the money that we're able to save, right? And saying, I want rate of return, rate of return, rate of return, and putting a lot of pressure there. But if we can address the money that we are spending and we can keep earning on that money, we can be very conservative with those earnings and still end up in a substantially better place because it is more money that we are earning off of. So let's talk about how this works at a high level. If I am using a cash-based purchasing system, first I have to save up the money, right? So if I put that money into a regular checking account, let's say I'm saving up $20,000. So we're kind of done with that car example, but we know we have a $20,000 purchase coming up. I know that if I am saving up that money and it needs to be liquid so that I have use of it in the near term, that I'll be lucky to earn somewhere in the range of 2%, but more likely it will be closer to 0. I know my checking account doesn't pay much. My saving account pays something nominal, but it's somewhere in that range. Of those earnings, all of those earnings are taxable at ordinary income tax. So when you think about what's actually happening here, if I make a purchase and I take money out of the cash system, I am no longer earning on the entire $20,000. I am only going to earn on the remaining cash balance because the rest of the money is out of the account. So what I experience here is that loss of growth that you see on that compound growth curve that we just looked at. So what we're suggesting is a completely different system. And we call this system the private reserve strategy. And we used to call it the private banking strategy, but the reality is you're not actually funding a bank. So from a regulatory standpoint, we can no longer call it a bank. So in this system, just like you did in the cash-based system, you first have to save up the cash, right? But here, that same $20,000 is going to be looking at earning closer to 4%. So already we have a higher rate of return on those dollars over your lifetime than you would see in a cash-based account. What I'm looking for here is use of the money, control of how I access the money, and uninterrupted compounding, because every time I interrupt the compounding, that growth is gone for the rest of my life. So what happens when you're ready to make a purchase here is that a financial institution, right, and we'll get more into how this is accomplished in a minute, but a financial institution is going to place a lien against your collateral, and then they are going to issue you a loan so that you can make a purchase. So I'm going to go back to using the 6% loan rate, even though we can do this differently, because I want to make sure that we're being very conservative in how we're talking about this. So when you take that loan at 6%, you are getting a loan from a financial institution and all of your money is continuing to grow. So what you have here is access to capital, even while yours stays on that compound growth curve. And if this is done properly, the way we do it, it is an unstructured loan. So an unstructured loan allows you to do a couple of things. First of all, it's interest only. So as long as the interest is, well, you don't even have to pay the interest, right? So if you don't pay the interest because it's unstructured, it just gets added to your loan balance. If you choose to make an interest only payment, you can, right? But you are not required to make that in an unstructured loan. So you get to determine the payment amount. So if 1 month you wanted to put $1,000 back, 1 month you wanted to put $10,000 back, 1 month you put 0. You have complete freedom for how you pay that loan back at any point in time, because it is a private contract. So it doesn't even show up on your credit report. The second thing is that you really get to determine part of the interest rate. So the institution is going to charge you a set interest rate for that loan. And it's important to make sure that the math works, that you're getting enough compounding in order for you to take the loan, which we've already seen the math on 4 and 6 does end up in your favor. But if you chose to pay that back at a higher interest rate, just by rounding a payment, you could do that. And the difference would actually go to you. And you can actually, again, determine the payback period. So you could say, look, I want to pay this back over 5 years or 3 years or 30 years. And the financial institution really doesn't care how you're structuring that payback, because they have your money as collateral. Another benefit of this is that the way we structure the private reserve strategy, you have tax-deferred growth and tax-free access to the money at any point in time during your lifetime. So how do we actually do this? And the answer is we do this with a specially funded life insurance contract. And every time we get to this slide, I'm like, oh, there's going to be people in the audience who are groaning, going, oh, this is a pitch for life insurance. But the reality is, I don't care what the tool is called. I only care what it does for you. And what I do know is that across the industry, there are very few advisors who understand the technical aspects of how to do this with a life insurance policy. And so what I want to do is give you a little bit of a tutorial so that you understand how this works. So for starters, what we're going to talk about is funding. Most advisors who are funding a life insurance contract want to sell you a contract that gives you the highest possible commission, right? And they aren't really caring about what ends up happening for you. So what we're going to do is talk about different types of life insurance and how to structure this contract. So the cheapest way that you can get access to death benefit is through term insurance. That's where you pay a very low premium and the insurance company says, look, if you die in the next 10 years or the next 20 years, we're going to pay the death benefit. If you use this type of contract, you have a very high death benefit, but you're never building a cash value. And that cash value is what is important here, because that's what we're going to loan against. So when you think about term, people actually say it's the cheapest way to buy life insurance, but I'm going to argue it's the most expensive because it is 100% cost unless you die. If I look at the most efficient way that I could buy life insurance, it's through something called a single premium life insurance policy, right? This is a one-time cash payment that buys me a life insurance contract, and it does not require or even allow any additional deposits in the future. So if you were to buy a single premium policy, you get a very low death benefit, but you have a substantially higher cash value. So if I think about what this means, I may pay $100 into a contract, and the cash value inside of that contract could be anywhere from $87 to $95, right? So I put $100 in, I've got, call it $90 sitting there in cash. The $10 that is no longer liquid and available is actually buying a permanent death benefit. And in this example, we're going to say that it's buying $300 worth of death benefit. So you have access here to most of your money. In the 80s, these contracts were incredibly popular because we were in a double-digit interest rate environment. And so if you put $100 into this, by the end of the year, you would have overcome 100% of the cost of the insurance, and you would have guaranteed growth in your account, and hopefully it would have continued on at double-digit returns. Now, here's some extra benefits. You still have access to money. The growth is tax deferred and accessible tax-free through the rest of your life. You have all of your money plus a death benefit, and you can then borrow the money out to go and acquire other assets. Plus you have protection from lawsuit and creditor. So if you're looking at this, you're like, hey, this is really sweet. I'm getting a double-digit return. Why on earth would I put my money into the stock market in this environment? Because I can get a double-digit return with no risk to my principal. Okay, that makes sense. If I put it in the market, it depends on how well the underlying company for the stock I bought does. So people were moving out of the market and into these contracts, and they were moving out of their banks and into these contracts because the payout rates inside of a life insurance policy are generally substantially higher than what you could get in a CD. So if you could get the same types of returns or better, plus the additional benefits that you would get here, why not do that? Now, unfortunately, when Wall Street and the banking industry start losing money, they don't like that, and they have plenty of money for lobbyists. And so what happened is there was kind of a line drawn in the sand where they went to Congress and they said, look, people are using these contracts to avoid taxes, right? Which was happening because you were getting tax-free growth or tax-deferred growth, but tax-free use of your money during your lifetime. And they're treating it as an investment. You can see that because they're leaving the stock market. So a line was drawn where if a contract has too much cash accumulation for the amount of death benefit over a specific period of time, it becomes something known as a modified endowment contract. Now, here's why that's bad. So we call that a MEC. So if you hear me say MEC or MEC, that's what I'm talking about. Once your contract becomes a modified endowment contract, if you are under 59 and a half, whenever you access your cash, it is now taxable, and there is also a 10% penalty for the use of that money. So now it feels just like a 401k, but without the tax deferral on the front end. So all of a sudden, something that was really sexy and exciting becomes really boring and not something that you would want to do. So why do I tell you all of that? In order to do this, the way we're going to fund it, because we want as much as we can possibly get in one of these contracts, what we're going to do is look at a traditional whole life policy. So this could be a whole life policy that's expecting premiums over 65 years, 95 years, 120 years. But what you can see is we went the wrong direction on the efficiency scale because we moved back over here. So what we're going to do to snuggle up right against this neckline without crossing it is we're going to add a rider to the life insurance policy called paid up additional insurance, or PUA. A paid up addition looks exactly like a single premium policy. So I'm going to use kind of a girly example here, but I think it makes a lot of sense. If I go shopping and I'm buying a purse, I have to balance the size of the purse with the amount of money I want to put in it. So I don't want to go and buy a huge life insurance policy because then I can't fund the lead that I need into that contract in the first several years. It's going to take much longer to see that cash show up. But if I buy a policy that's really, really tiny, I'm not going to be able to get enough cash into it to accomplish the things that I want to do. So there's a balance between what you fund in terms of mandatory premium and then the optional deposits that overfund the contract. Now, the more I overfund the contract into that paid up additional insurance rider, the more efficient the policy is, the higher the internal rate of return, and the closer I get to that modified endowment contract line. Now, I want to be really, really clear about this. If you ever accidentally cross the line, the insurance companies, by regulation, are required to notify you. And as long as you respond to that notification within 90 days and say, hey, that was an accident, please refund me the money and push me back to the correct side of the line, they are obligated from a legal perspective to do so. So it is never an issue unless you just don't deal with it when it shows up. And we have had that happen with clients once or twice where they get overzealous and they don't ask us where the line is and they just send money in. So then they call us in a panic saying, hey, I did something bad. And then we can help them correct that very easily. So here's the thing, for every dollar that I put to the whole life insurance policy, I can get about $3 into the paid up additions on an ongoing basis. There are some first year exceptions where you can get up to 10 times your basic premium into the cash, and then you can get up to 3 times that moving forward. So how you fund this also depends on the goals that you have for the contract itself. But we want to make sure that we fund it as efficiently as possible, because then we have the ability to loan against the cash. So let's do a comparison real quick between using cash to buy an investment and using an insurance contract to buy an investment. So in this example, and I know everything's just popping up on the screen, so I'll use my cursor for where we're going to focus. If I have $100,000 that is sitting in a cash account, I'm going to take $100,000 out of that taxable account and I'm going to put it into a hypothetical investment. And we're just going to say this is real estate in this example, and that it is hypothetically earning 10% each year. 10% of 100,000 is $10,000. I know that I'm going to probably have to pay capital gains taxes on that, potentially ordinary income tax, but for this example, we're going to use capital gains. At a 20% tax rate, that means that I am going to net $8,000 on my investment that year. So I may stick that into the cash account and just hold it there. Well, if I hold this investment for the next 10 years, $8,000 times 10 years is $80,000 that I have in my pocket. At the end of that 10-year time period, I'm going to liquidate the original investment. And let's say that that $100,000 investment I made is now $200,000. $100,000 of that is a return of my principal. It's the investment that I made, and $100,000 of that is growth. I don't have to pay taxes on the return of my principal. I do have to pay taxes on the growth. So at a 20% tax bracket here, that means I lose $20,000 to taxes and I net an additional $180,000 back into my pocket. So 100 of that is just a return of my own money. 80 is profit at that point, right? That's pretty simple math. So if I look at what's happening here, I had the $80,000 that came from each year's income from the property. That's my net number. And then I have $180,000 that came when the investment liquidated, again, net of the taxes. So I end up with $260,000 in my pocket, and I have paid $40,000 to the IRS. So now let's look at this with the other system. So if I have built out $100,000 into my insurance contract and I take a loan against it, right now, most insurance companies who have non-direct recognition loans, which is absolutely imperative if you are using this system, and we'll go into that here later if you guys want to. But what we're looking at here is taking a lien against the $100,000. Then the insurance company is going to go to their general funds and they are going to loan the money at, let's call it 5%, because that's going to make my math really easy. We put it into exactly the same hypothetical investment. It earns 10%. That's $10,000, same as it did last time, but I owe the simple interest on that loan of $5,000, right? That's my interest only payment to the insurance company, which means that my net is now $5,000. And I have to pay the same 20% in taxes, which is $1,000, which means I have $4,000 back in my pocket here. Now, here's the thing. I'm going to make the assumption that we're not paying down this loan along the way. We're just letting that money sit. If I am paying the loan down along the way with the profit, these numbers get even better in my favor. But if I am only netting $4,000 instead of $8,000 over 10 years, I've got $40,000 in my pocket from the cash flow, right? Now the original investment liquidates. It's the same $200,000 as it was before. 100,000 of that is my principal. I'm going to use that to pay back the $100,000 loan. And then I have $100,000 worth of growth. I have to pay 20 grand in taxes, which means I've net $80,000. So let's add all of this up. The $40,000 that I got from the cash flow plus the $80,000 that I got from growth. And then all of that $100,000 was continuing to compound inside of that insurance contract. So if I look at the cash value where it originally started at $100,000, even if I'm not contributing anything else to it, the cash value of the life insurance is now worth $158,000. So if I add those three up, I am now at $278,000. And I have only paid $30,000 in taxes. So let's compare that real quick. In the private reserve strategy, I ended up with $278. In the cash strategy, I ended up with $260. The improvement using the private reserve strategy was $18,000 in my pocket, and I paid the IRS $10,000 less in taxes. So here I'm winning on both sides. I got more money in my pocket, and I gave the IRS less money at the same time, right? This is the strategy that we want to teach our clients is how can you get more from the investments that you're already doing? And if you're using an insurance contract as the basis for your purchases, essentially it is the holding tank for your capital in between the transactions that you're going to do. So you can see that you're substantially ahead here. And if you repeat this process over and over and over again with your cash flowing investments, it can make a difference of hundreds of thousands or even millions of dollars during your lifetime. So I'm going to pause for a second because we're coming up on time real quick. Kara, do you want to go through and do the polls, and we can also open it up for questions?
Yes, we'll put that up right now.
And I'll go ahead and stop sharing my screen as well so that I can see what's happening with questions in the chat box. And if you're doing a poll, will you let me know? Because again, I can't see it on my end.
Yep, we're doing a poll right now. We are asking based on the information that we've learned today. And it looks like results are coming in. Do they think they're on track or they don't know? It looks like 45%, it's like equally split. 45% think they're on track to maximize their income and 33% don't know.
What's our next question?
Yes, next question.
And actually, while you're doing that, there is a question that I'm going to go ahead and repeat. So someone asked, how close can we get to using our policies like credit cards? And I love the commentary. Girl, we spend a lot of money. Yeah, don't we all? So here's what I would say. I think it becomes very clunky to use this like a credit card where you have kind of a revolving debt. I mean, certainly if you were taking like loans, using it like a line of credit, you can do that, but it creates a lot of in and out and it becomes harder and harder to keep track of that. Most insurance companies will let you access your cash as frequently as you want to. However, they frequently encourage their advisors to try and limit that number because it does trigger some anti-money laundering requirements for the insurance company. So internally, it does increase their expenses. So what I would say is, for smaller purchases, you're probably not going to use this system. But for each family that we work with, we really try to define at what size does it become really important to use this system for the purchase itself. So I can tell you that for me personally, I use this system to pay my taxes. So I fund the money into the insurance contract, then borrow against it to pay my taxes. And over the course of the next year, just like I would put the tax money into a savings account, I just eliminate the lien. And then at the end of that year, I'm going to write a check for my taxes again. And so what that does is it allows me to keep the growth on money that I am sending to the IRS, whereas most people just put it in a checking account and then send it off, and it never makes it onto the compound growth curve. This makes particular sense for, if you're buying real estate or something that's producing cash flow, so that you are acquiring the property and then using the cash flow to pay the loan back. So you end up with all the cash and the growth in the policy plus the profit from the rental property. Whereas if you had paid cash, you'd have the profit from the rental property, but you would have given up all the growth on your cash. So there's a lot of application for this. Eric, you put a great suggestion in the chat box. Property taxes, if you self-escrow as opposed to paying them through your mortgage, is another great thing that you can do this for. And so you absolutely can use this for other things. I used my policies to pay for a remodel in my backyard, where I put in a pool and an outdoor living space and then paid it back over time. There's any number of things that you can do it. Again, I probably wouldn't want to do the in and out of every month, just because then it gives you a lot to keep track of and the hassle of doing it. But if it's done correctly and you need access to your funds, you can access about 95% of what you have in your policy. And typically you can have the money EFT'd directly to your account. So there's no hold period in a 5 business day period or less. And then you can structure the loan payback however you want. So, one example would be if you wanted to flip a house. If you did things the traditional way, you would be making payments even while you're doing all the repairs to the house. Whereas if you used your policy, you could just not pay anything during the period. And then whenever you sell the house, you could replenish it, add to the paid up additions, and then do it again. And then let me see this. So one of the questions is, does the beneficiary need to be notified when making a withdrawal over a certain amount? That's actually not the case. So what does happen is Texas in particular. So if you're not in Texas, this might be different, but if you live in a state that is a community property state, then if you are doing a loan against the policy and it is for more than $5,000, your spouse also has to sign off because it is community property. But that would be really the only time that you would need an additional signature. If you live in a state where it is not a community property state, that's not a requirement. But because the money is technically owned by you and your spouse in a community property state, you do have to have their signature on the form. And then let's see, I think there's another question in here. Is there a time when it doesn't make sense to continue overfunding the policy? Yes and no. So definitely the overfunding in the policy is the most efficient in the first 4 years. So if you run the math, overfunding a policy in the first 4 years gets more money on the compound growth curve and overcomes any of the internal fee structure in the life insurance contract. So by funding aggressively in the first 4 years, what happens is you actually increase the internal rate of return in the policy. So it is particularly advantageous to do it in the first 4 years. Once you get beyond the first 4 years, it still makes sense to put money into a policy, but it is not changing the internal rate of return. It's still getting on the compound growth curve. It's just not changing it. Now, if you fund this aggressively enough, you're going to hit a point where continuing to overfund it will create that modified endowment contract and throw you into the adverse tax treatment. So when you get close to that point, our normal recommendation is it's time to open a second policy. So just by way of that, I currently have, I think, 15 policies between me, my husband, and my kids. That grammar was terrible. I apologize for it. But what happened is, as my income went up, as my investments were performing, we kept adding to the system because we needed the capacity. So whenever you have the need for a capacity increase, it can make sense to add on an additional policy. Otherwise you're going to run into a time period where you can't put additional funds into the contract anymore. Let's see. So, Kara, can you unmute Eric for a minute? Because you made the comment about if the policy is assigned for a bank loan, is that when you have to get permission to access the cash? Is that what you were answering to?
Just to answer Charles's question on that one.
Yeah, if you are using the death benefit as collateral for a loan, or the cash value as collateral for a commercial loan, as opposed to with the insurance company, you might have to have permission at that point, especially if it was going to change the amount of death benefit that was securing a loan. Good point.
I thought that might be what he was asking first, because the beneficiary then would be the bank.
Right. Yeah, in that situation, you might have to ask for permission. Other questions? Even if it's questions about application, let's see, here's one. How do you determine the security or safety of the insurance company? So let's talk about whole life insurance for a minute and different types of insurance companies. So I'm going to start with the different types of insurance companies. There are stock-owned insurance companies and there are mutual insurance companies. When you were looking at buying a permanent insurance policy, I would very rarely consider a company that is stock-owned. And this is my personal preference. The reason for that is in a stock-owned insurance company, the fiduciary obligation of the C-suite is to the shareholders and not to the policyholders. So when you look at how their contracts are designed, they frequently have aspects in them that are adjustable or variable, so that if they need to create profit for their shareholders, they can more aggressively change the fee structure, and that hurts the long-term performance of a policy. A mutual insurance company is owned by its policyholders. And so if you buy a permanent insurance contract at a mutual company, the fiduciary obligation is to you because you are the owner. So if they raise the internal fee structure on your policy to create more profit, they're just then putting that profit back for you. So you see a lot less monkeying around with the fee structures because of who the fiduciary obligation is to. And I think that's incredibly important. The other thing is that when you were looking at whole life insurance policies, the regulation as of today is that the insurance contracts, because they have guarantees associated with them, the insurance companies are required to keep dollar for dollar reserves. If you compare that to the bank, where most people don't spend any time thinking about how safe their bank is, the bank does not have to do that. Their reserve level is generally about 10%, sometimes even less. So when you think about that, the bank is loaning out the same dollar multiple times. If there's a run on the bank, there's maybe not enough capital there. But when you look at what's happening in an insurance company, at least on their whole life block of business, whatever is guaranteed inside of your contract is held in a dollar for dollar reserve. It has to be there. So already from a stability standpoint, that's pretty good. Historically, what's happened when insurance companies have gotten into trouble, and I'll give an example of this because it's recent history. Within the past couple of years, MetLife, which was a mutual company, demutualized and then sold off their insurance block of business. Mass Mutual actually bought that block of business because what they're buying is cash. So the likelihood that you're going to lose the underlying asset is incredibly low, even when an insurance company gets into trouble or chooses to get rid of a business line because they don't see it as being their most profitable line, which whole life typically is not. That's why you tend to see that in mutual insurance companies as opposed to private equity owned companies. The profit margins are very different. And so right there, that's already a big step. And then the second thing beyond that is, there's the FDIC that insures up to $250,000 for banks. And there is the SPIC, which insures up to $250,000 for securities accounts. And the state of Texas takes the same approach because insurance is regulated at a state level. They actually have a bailout fund that offers the same types of protection with the same limits. So, one thing that I do think is important is really understanding the overall financials. Almost every mutual insurance company is going to post their financials online. Now, there are other things that we could say, like look at a Comdex rating or look at the Standard & Poor's rating, but I don't put as much stock into those types of ratings. I think they're okay to look at, and as long as you're above 90 or you're an A-grade insurance company, I think you're fine. But I think we also have to understand that Enron got one of the highest possible ratings that you could possibly get from all of the ratings agencies, and we know what happened there. And in 2008, the rating agencies went and downgraded pretty much everybody with few exceptions, which means that their ratings were incorrect in the first place. So I think it is really important, first of all, to look for a mutual insurance company. And then you really want it to be probably in the top 5 or 10 in terms of size. And then you're in good shape because they're all looking at the same actuarial data. And because of how they're regulated, their investments are really all pretty similar. So it's kind of a what flavor do you want? And at that point, I think it becomes most important to understand the contract itself and the moving parts, because if you're going to do this system, there are certain things that absolutely need to be there. Some companies require you, if you're putting in extra money, to overfund by the same amount every year. And if you miss a year, you lose the ability to do it. Other companies have flexible funding where you can put up to 3 times whatever your base premium is, but you can put as little as $120 a year. So that flexibility is key. So the contract features at that point, once you've got a decent insurance company, the contract features are really the driver. Other questions for me? So one of the questions that just popped in is, why isn't this the norm? I have a lot of opinions about this. For starters, I think that we have some issues in the financial services industry as a whole, because you have investment companies and you have insurance companies, and they're in competition for the same dollars. So our firm is looking at the whole picture. We manage investments. We help people figure out if their real estate investments are cash flowing. We look at their insurance. We view money as a dynamic system as opposed to just taking money and dumping it into a bucket. I think part of what happens is you have 2 sides of an industry that are like children fighting over the same toy. So the investment guys are saying, pay as little as possible into a term insurance and then put all your money into the market. We're going to get you the biggest rate of return you could possibly get. Put all your money here. And then you have insurance people saying, don't put your money in the market. That's basically gambling. You need to put all of your money into a permanent insurance product. You're going to be better off, right? Have you seen a Dalbar study? You're going to end up with better returns than most mutual fund investors. So you have 2 groups that are selling against each other, as opposed to looking at, okay, how do we look at all the tools available and design a system that allows us to do this? The other thing that I'll tell you is the insurance companies don't particularly love this as a system because it creates extra work for them. So when you look at this, especially in a low interest rate environment, that extra money coming in, because it has to be immediately liquid, puts extra pressure on them to find investments that have high yields in order for them to hit their guarantees. And because it means people are funding the money and then making withdrawals and then putting money back in and making withdrawals, it's a lot of additional work for the insurance companies. So they don't teach this. They want regularly scheduled money coming in. So if you think for a second about kind of the 4 rules of financial institutions, you all know them, whether you realize it or not. They want your money. They want it on an ongoing and predictable basis. They want to hold on to it for as long as possible. And then they want to make it as difficult as possible for you to get your money back, right? And so when you think about insurance, if I'm committing to a high mandatory premium, right, they're getting my money, they can predict exactly how much they're going to get and for how long. And then they don't want me using it. They want to hold on to it so that they can use it in order to grow it, right? And so it goes, this goes directly against what financial institutions are looking to for their own profitability over the long haul. But if we look at what the banks are doing, the banks are doing this. There's something called BOLI. You can Google it, bank-owned life insurance. Most banks are buying large permanent insurance policies on their officers so that they can use that to pay deferred compensation. And then when the officer passes away, the bank is made whole with the death benefit. So there's a lot of people doing this. And I think what you'll find is when you start looking for it, you're going to find a lot of people doing it. So at our firm in particular, I can speak just for myself. I personally have over 1,000 clients who have all seen this is how the system works, and they have the ability to do this with the contracts that they've entered into. And if I add in the rest of advisors, that's probably closer to 2,000 people just in our little book that are doing this. But if you start looking for it online, what you're going to find is there are entire communities of people who are doing this and have been doing this for decades. Good question. Lots of good questions. Who else has a question? I think that might be it. If anyone else has a question, please feel free to reach out to that invited you. If you have interest in seeing how this could dramatically change the amount of money that you're holding on to and have access to during your lifetime, let your know that they'll probably be reaching out to get feedback from this as well. The more honest feedback we get, the better we can customize all of this. So thank you guys very much for attending today. Just as a reminder, follow us on social media. You can find me at The Wealth Woman on Instagram or Facebook. The company, the company tag, am I saying that the right way, is at Benchmark Income. And if you'd like to subscribe to our newsletter so that you can be made aware of other webinars and things that we have going on, please go to benchmarkincome.com and sign up. And again, I highly, highly recommend, I may be biased, but I highly recommend our podcast as well, the Big Wealth Podcast. You can find that anywhere that you listen to podcasts. Thank you guys very much for joining us today. I hope the rest of your day is wonderful.